Welcome back to Catching Up to Five. Have we got a special Wednesday episode for you today? We joined the group of women at Sheconomy. It's called our Sheconomy. We'll drop that in the show notes, but we had so much fun, right, Bill?
Yeah, we were talking with our friend Janine Firpo and a bunch of women. We had a great event. This is a fantastic organization that it tries to reimagine what our financial world would look like if women had financial parity or equity back 100 years ago. So it's something you should really look into with regards to the website, oursheconomy.org. And the other organization that Janine runs is Invest for Better, for women's financial empowerment. And we're all big fans of that, right, Jackie?
Yeah, Janine was on our podcast several months ago, but we'll drop that in the show notes as well. And the most fun part that we did is we played this trivia. So we have a question for you. How much do you know about your women's history? Because we got tripped up on a few of these, right, Bill?
Yeah, I mean, there's a lot of things that happened in women's financial history that are more recent than you think they were if you really dig into it. And it's important to understand the history of financial equity and equality so that we don't slide backwards and just keep moving forward with empowering women to own their own money as well.
That's right, Bill. It is going to be an eye-opener. So take a listen. Let's go ahead and roll right into it.
Welcome to Catching Up to Five, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to five together.
Hi, everyone. Welcome to this very fun Our Sheconomy webinar. I'm Janine Firpo, and I am the co-founder of Invest for Better. And I'm really excited because today I am joined by three experts, and we're going to have a little bit of a game show with you, which I'll explain in just a minute. But first, I want to introduce the other people that are in the room. So first, we have Jackie Cummings-Koski, and she is a certified financial planner. She is also an accredited financial counselor. She is a financial educator. You can see her book in the background. She's actually written 2 books, and she is absolutely passionate about helping women in particular become really confident investors and to really change their financial lives. Second, I want to introduce you to Bill Yount. Bill is a really unusual person. He is an emergency room doctor. And he got into this whole space of finance because he realized kind of late in life in his 50s that he hadn't really thought about retirement very much. He made a good income along the way, but he wasn't putting away the money that he needed to retire. And he realized he was kind of behind the 8 ball. And so he started really learning, and he ended up creating a podcast that he eventually brought Jackie onto. So the two of them are now running this great podcast called Catching Up to Five, which stands for financial independence. And they're teaching people, particularly those like him who started late in life, and Jackie did too, how they can build financial wealth and retire. So another very interesting surgeon turned financial advisor. Interestingly enough, Sarah, our last expert, is also in the medical field, and shockingly, is a professor of surgery at the University of Arkansas. But she also went into the finance space. So she is also a certified financial planner. She is the founder of a financial planning firm, and she does a fixed price kind of counseling and consulting with people, which is really unusual. And I think so important to move away from that model where you have to have all of your money under management by your financial advisor. And like Jackie and Bill, she is also passionate about helping women really step into their financial power. So I'm delighted to have them all here. Thank you all for joining me on this panel today. Thank you.
Thank you for having us.
Yeah, Janine, thanks for having us here. This is great.
Yeah, it's going to be fun. So here, you guys, is what we're going to do. So I am going to ask a series of questions. We're going to put them up as a poll. All of you who are watching will have an opportunity to vote. We'll show you the responses, how you all thought the outcome should be, and then we'll have the experts give their opinions, give you the answer, and we'll talk about that particular question a little bit. And to make this even more fun, what we're going to do is both Bill and Sarah have offered some gifts for you. So if you participate in the polls and you chat, feel free to put comments and so on in the chat. We'll be watching all of that. And if you're participating, then at the end of the session, what we're going to do is we're going to take that list of people who participated, and from it, we will randomly select 10 of you who will receive some prizes. So some of you, half of those 10, will get $50 gift certificates from DAFI, which is Bill Yount's DAF, his donor advised fund. And it's a really cool DAF because anyone can join it. You don't have to have a minimum amount of money. He might talk to you a little bit about that in the session. And Sarah is also going to be offering packets of her book, which is called But First Save 5, and a set of cards to help you have money conversations. So participate and you can win these great things. Okay, so what we're going to do here is we're going to get started by talking a little bit and looking a little bit at the past and where women have traditionally been in terms of money and the economy. So interestingly enough, there's something in the United States that's called Equal Pay Day. And it marks the day in a year when women will catch up to the income that men had made in the previous year. So for example, if a man worked until December 31st, 2025, and he made X salary, this is the day that women have to work into 2026 until they make the same amount of money the man made by the end of 2025. So question number 1 is, when was Equal Pay Day in 2026? So go ahead and vote. And in a moment, we'll show you the results.
I almost got this one wrong, but
you can't say the answer yet, Jackie.
I'm not saying the answer. I'm not.
Wait until we show how everybody did.
But you did give us a clue, right? You said, when was Equal Pay Day in 2026?
Mm-hmm.
That's implying that it's already taken place.
Oh,
that's
These
right.
women are smart.
Jackie.
Okay, so Jackie, you're right. I hadn't even thought about that. So when was Equal Pay Day?
Equal Pay Day, and this is the average of all women, was March the 26th.
Yeah.
All right. Now, and I said, and I mentioned the average just because for different demographics of women, it's a little bit later. So for me as a Black woman, Black women's Equal Pay Day is July the 21st. And then if you're a Latina woman, that is October the 8th. So it does vary by different demographics. And we'll put in the chat a link to where it breaks it all down. It's called the Equal Pay Day calendar, but it shows you based on different demographics and things like that, what, when Equal Pay Day is for that demographic. And I guess, I don't know, you probably know more about the cents on the dollar, but that varies by demographic as well. We know women get paid less than men.
Yeah, well, it's not only it is the cents on the dollar, but here's the really sad fact. Back in 2009, the cents on the dollar was about 78 cents. Now, here we are 15 years later. It's gone all the way up to like 83 cents. So it's been about a 5 to 7% increase in 15 years.
Yeah,
we got to pick up the pace.
What's interesting to me is my wife and I watched a documentary or a true life story of Lilly Ledbetter. And I don't know if you've seen this. I think it's on Netflix. And it was only in 2009, I think, right, that this law was passed because she sued Goodyear Tires back in Alabama in the day and stayed the course because there had been wage discrimination, among other forms of discrimination, for years. She won, and things monumentally changed under the Obama administration when he signed the bill. But there hasn't been, since the passage of that act, much movement from a dollars and cents standpoint, right?
No, like 5%, not much movement at all. So this has to change, as do other things. But the good news is this is kind of the past. We're looking at the past, and we're gonna look at where we are now, and then we're gonna look into the future as well. So we're going to go on to our next question about the past, and that is, when did women in the United States get the legal right to get a credit card or loans without a male cosigner? When did that happen?
Yeah, that's another one that infuriates me. I won't give the answer, but it was a little shocking to me.
Mm-hmm.
Well, my mother gave me a lot of perspective on this because she lived this. This was her lived experience, and she wasn't on the mortgage to our house nor on the title. It was, and that was a sticking point. I had no idea growing up as a man that there was this much discrepancy, and that coming to this ability to get credit late in the game for women. I was shocked when I found out the answer.
What's interesting about what you just brought up? So I live in a neighborhood that homes were originally built here about 100 years ago. And a neighbor keeps track of all this stuff. And I went to her house once, and she showed me all the maps of how the property had been allocated like 80 years ago, 70 years ago, something like that. And what was shocking was almost all the properties were owned by women, except they weren't. It turns out that men were taxed one way, women were taxed another way. So all the men had the properties put into their wives' names so that they could get away without paying the taxes, but the properties were still owned by the men. So women have been used for economic advantage as well. So Jasmine, I didn't see the answer. Did you pop okay, there we are. This is a smart group. So Sarah, what do you think about this answer, and what is the true answer?
Yeah, so legally, the true answer is 1974, but the actual true in practice answer is that the statement that was being made in, previous to 1974 was that women cannot be trusted with money. The same trope, women are not good at math, girls aren't good at math. Women are not good with money. That's the statement. I mean, we can talk about it being credit and you can't buy a house and all those kinds of terrible things, but it's the bigger message that's the problem. So now, I do a lot of public speaking, and I'll speak to these large rooms of women, and they'll come up and be like, wow, that was really interesting. And then they'll lean in as if they're the only person that's ever said this to me before. And they say, but I have my husband do all of my money. Now, I will know for a fact that some of these women are heads of hospitals, own their own businesses. And it's so fascinating that we really believe that we're some kind of aberration, but really what's happening is we have not culturally decided that women are good with money. So yeah, the law has passed, but we still see very low participation of women in financial planning, in investing, and in their own money.
I see the same thing. Jackie and Bill, what do you see?
Yeah, I see this. I see the same thing, and an area that I feel like is that I've been following a lot of the rise of different scams and things like that, and it seems like they disproportionately impact women, and a lot of times it happens at the most vulnerable moment where the spouse has passed away or they got a divorce. Like Sarah-Catherine said, there was they weren't involved in the finances, so they were just very easy targets, and that really frustrates me that it's leading into that. Women live longer, and potentially they could be bigger targets of scams and misbehaving, from nefarious people. So yeah, we definitely see that a lot. And Bill, you were about to sort of share your thoughts as well.
Well, my mom's been scammed once successfully and once unsuccessfully to the tune at one point of 1 year's expenditures, which, she was not the CFO of our family. My dad was, and she grew up sort of in that shadow and with the fear that I think is instilled that no, money is not a woman's domain. But that is, as we know, absolutely not true. And we're better off handing our money off to women like Sarah-Catherine, who are going to take better care of it, or Jackie for that matter. I'm a big proponent of female financial empowerment because I honestly think women just do better with money, as we'll talk about today.
Yeah, they do. And the other thing that I think that women don't really understand is how money is tied to power. And when we give up that agency around our money, when we hand that off to a husband or a partner or whatever, we're giving up our power. And the other thing is, chances are, because we live longer, because a lot of people get divorced, because we don't get married as soon, because we're making our own incomes, chances are there will be a time in every woman's life where she is on her own and where she needs to be aware of her money. And you don't want to figure that out when you get a divorce or when your husband passes away. That is the wrong time to be figuring this stuff out. The good news is that younger women are stepping up more to the plate, which is great. And while we have looked back a little bit, what's really interesting to me is, what do we actually do with our financial power when we do step into that financial power? And part of the reason we're seeing the challenges that we're talking about right now is because this transition doesn't happen overnight, right? We are not being trained traditionally we were not trained how to deal with money. So we're in a transition phase right now. Some women of older generations have learned, they're teaching their daughters are learning in other ways. Younger women are investing at a faster rate, which is great. And so that dynamic is beginning to change. But what's really interesting to me is that when we do take control of our money and we do start investing, we do it really differently. We do philanthropy differently than men too, which is also fascinating to me. So our next question is a little bit of a trick question, because I'm going to suggest that women outperform men when we invest in the stock market. So do you believe me? Do you think that's true? And if you do, then how much do you think women outperform men? I love this one.
I do too.
Yeah, I love seeing the transition that's going on now. And I love seeing how younger women are really stepping up and recognizing the power of their money. One of the things that in fact, I was talking to a group of young people the other day, and I was talking to them about how if they start investing when they're 20 and even do that only for 10 years, how they will be better off in the long term than somebody who waits until they're 30 to start investing. So it's so important to get started young.
Well, and here we have to remember the power of compounding, which is a force that really needs to be taught earlier in life. And even if the margin is only a small fraction of a percent over 40-year investing career, that adds up to real money.
Yeah, it's true. It really
Absolutely. Does. And to your point about, young women now are starting to invest sooner. So my daughter, she's in her 20s and she's very comfortable around investing. And she taught her boyfriend, now fiance, how to invest. So I was pretty darn proud of that. And your intern, Rachel, she was saying that it was a young man that, she learned from or was talking about it. So I'm happy to see the shift a little bit.
Yeah, absolutely. So Bill, how did our respondents do here on this?
Oh, they were actually, they thought women did better than they really did, which I think is great. That positive force, and that can well be true, but for right now, it's 0.4 to 1.8% per year on average better, which is not insignificant by any means at all.
Yeah.
Yeah, Yeah, and I'm thinking, I don't know if this survey is right because I think it's over 5%, but I guess
Same.
I guess the stats don't say that, so that's okay. But yeah, and I think a lot of times women might be more willing to share and impacting more people. Just like you're doing, Janine. You're impacting a lot of people, and sometimes it feels a little bit like gatekeeping. I mean, there's nothing really new under the sun, but it's like. I hear a lot, Sarah-Catherine, you probably hear this too. It's like, come invest with me. I'll get you a greater return. Let me show you this. Let me show you that, so.
Well, Sarah-Catherine, let's talk about why that is, because I think the power of women with money is kind of in their mindset, in their values, in their goals for it, because they have I think a higher purpose for it. Why do we think? And I have my own theories, but the science. Why do women do better?
Okay, well, the reason women do better is the same reason that women have traditionally looked at investing and said, no, thank you. So you can invest or you can try to win when it comes to stocks. And I think previously, when you were investing, yes, you were investing, but there was this idea of, I want outperformance. If my neighbor is doing 5%, I want to do 7%. And then this had a lot of day trading involved. A lot of people were talking about these very, very complex investment strategies. And I think we were looking at it going, yeah, no, thank you. I mean, that's not interesting to me at all. And then what I think happened is especially with passive investing, first of all, we learned that doesn't work, and I'll give the stats on it. But then with passive investing, we finally saw a way forward where it's like, oh, I understand. So if I buy all 3,600 US stocks out there, those are companies that make things or have services, and they have CEOs that are responsible for growing my money. So I'm going to make money while I sleep. So I'm not trying to win. I'm just trying to grow my money. And I think that is where we started looking at investing going, now that I understand. And so the statistics play out really well. So if you look at one of the kind of earliest big studies, this Berkeley study back in the 90s, that women outperformed men in trading across a lot of different platforms. And basically the idea is, over trading. So this idea of picking stocks leads to, it's overconfidence that what's going to happen with certain stocks leads to over trading. And then over trading leads to underperformance. And so it turns out that women look at the stock market and we are totally underconfident, right? So we are like, oh, I have no idea what I'm doing. And so it's our underconfidence actually that brings humility to the table. And so then what we do is we buy in ways where, you buy and hold. We're not trying to trade. We're just buying to invest for the long term. And so for many women, we're just getting average performance, right? But if you look at it, and if over trading underperforms the average, then being average is outperforming. Does that make sense?
No, absolutely. Men tend to take, just like doctors, they want to make it complex. They want to take high risk. High risk means high reward, right? But then you've got this turnover, which add costs to things. The risk, the jumping in, jumping out, just buying, holding, staying the course with a passive investment. Women get it. Men have to kind of add alpha or value somehow, and because otherwise we wouldn't be men, right? Conquering the world. Women don't care about conquering the world. They just care about winning the game. There's actually an article called Winning the Loser's Game. It's about, we are not professionals playing professional tennis players. We're not trying to hit a winning shot. We're just trying not to lose the game, and we just got to get the ball back in the court and let our opponent defeat themselves. That is winning the loser's game, and I think women get how to play tennis. My mom loved playing tennis.
Can I take a minute and just say, Bill, how amazing it is? Like, you have such a terrific view on this. And I think all women are like, how could there not be more Bills in the world? So really wanted.
Yeah, it's very true. Acknowledge him. And actually, there's a colleague of ours just did something, because another area where women are really there's not enough of them in this financial space is as women who manage investment funds, right? So I think that according to our colleague, it's less than 1% of all of the money in the world is managed by female fund leaders. That's it. And so she is one of those women, and she has started this award called the He for She Award, and it's for men who are advocating for and supporting women in moving into those kinds of roles. So I think Bill is definitely a he for she as well. And so it's delightful to have him be part of this. So I think, what we're talking about here is women who are actually very smart about money when it comes to investing. And the other thing that women are very smart about is business and how to actually start and run businesses. And the problem is here that when women go out to raise capital for their businesses, whether they're looking for private debt or private equity, it's really, really hard. And it's particularly hard in the private equity space, because in that space, of all the venture capital that is invested in this country in any year, only 2% of it is going to female CEOs. That's it. And not only is that it, but it has held steady and even declined a bit over the last multiple years. And going back to what Jackie was saying earlier about the pay gap, this gap is also different depending on whether you're a white woman or not. And if you are a female entrepreneur of color, then you are getting less, like a fraction of 1% of all the venture capital money in the country, which is terrible. So when you talk to people about this, particularly male VCs and other people who pay attention in this space, they'll say, oh, well, women aren't getting the money because they're not building good businesses and they don't deliver the same kind of return as men. So our next question for you is related to that. According to Kevin O'Leary from Shark Tank, what percentage of his investment returns come from companies run by women?
Now, I'm going to say I was not surprised by this at all. And this corresponds really to the audience that's in Catching Up to Fi, who are late starters and trying to catch up. About 75% of our audience is women.
So your audience is largely women on your show?
3/4 at the last straw poll, sure. I mean, yeah. You've got gray divorce, you've got medical trauma, financial trauma. Divorce is a huge one that causes a late start for women.
Raising the kids a lot of times. And one interesting thing that people might not know is that when we look at the demographics on YouTube and who watches our channel, it is actually mostly men. And I was digging around with why that might be. And part of it was that women are typically multitasking. It's like they're breastfeeding and pumping their breasts while they're listening to the podcast. They are doing the dishes or something around the house, or doing the laundry. We just typically multitask more than men. And that was just one of the sort of ideas of what might be behind that. I don't know if there's any hard research, but curious what other people might think, why it seems that more viewers on YouTube are men and more listeners of podcasts is mostly women.
I think your multitasking is a really valid point. I mean, I listen to podcasts while I'm riding, exercising, or doing something like that. And I don't watch YouTubes because I don't have time. I think is a valid point.
Yeah. And in particular, I feel like it's a lot of moms, especially when the kids are small. You've always got one kid in your arm doing something else. Like you are never, even when you never eat without the baby. And it's typically the mom where the baby's clinging on or whatever. So just from the early days, we just learn how to multitask so much. I'm sure there's other reasons as well.
Actually, Sarah-Catherine, this would be a good question for you, because as we now learn from this poll, People mostly got it right. They said 60 or 75%, and the answer is 75%. But Sarah-Catherine, how many female-led financial planning firms are there, and what percentage of women are in the financial services industry? Because now that women are taking back control of their money, they may well want to talk to other women. What has the history of that been? What is it now? Because it almost corresponds to this. And then in the end, do financial planning services run by women do better than their male counterparts that are apples to apples comparison? That would be interesting to me.
Yeah, I don't know all the answers, but I will say there's not really good definitive data on how many women-owned investment firms, investment advisory, financial planning firms there are, which I would fit in some version of those categories. Somewhere probably between 5 and 20%. I think, Jackie, you might have better data on this being closer with the CFP board, but I think about 30% of financial planners now are women, and that's maybe growing.
Oh, girl, you're way too high. No.
Oh, okay. What is it?
For the women that, okay, there's 115,000 CFP professionals that hold this credential, and about 24% is female. So we all know that females represent about 50% of the population. so that's quite low. And the CFP board seems to support, trying to help more women, bring more women into the industry, because there's a lot of female consumers and prospective clients that want to work with a woman. And if there's a limited number of female CFPs, then, that leaves fewer choices for the people that are looking to work with a woman CFP.
Yeah. And, another interesting thing I was thinking about as y'all were discussing this just really kind of popped into my head is the number of people, and I will say mostly men, who told me there was no way my business was ever going to work. So this was 15 years ago. We're about to hit our 15th anniversary, and we've got 17 employees. We're in 49 states and SEC regulated and the largest advice only firm in the country. And you know what? This is what they would say. So, my idea was I wanted to have a financial planning firm that was ethical, that people could, instead of having to buy a product, in order to get your help, or have to have money in order for you to get financial planning, which never made sense to me. Don't you need financial planning to get money? But whatever. So the industry didn't make any sense to me. So I thought, well, why can't people just go pay for advice? And the biggest thing that pushback came down to, you're not going to make enough money. So only about 5% of people actually make it in the advisor space. And that's just because it is really difficult. It's a lot of sales. It's a lot of hard work for people to get that kind of traction. And it's like you're trying to hit the lottery. You're not just trying to make a living. You want to make loads of money, right? Because you want to accumulate assets. You want to charge a percentage of those assets. And it's infinitely scalable, right? Because you can just take more and more and more assets and make more and more and more money. And let me tell you, I am not allergic to making money. But what I was most interested in was building the right business that would be right for people. And that's where where I was getting a lot of feedback. You're never going to make it. It's going to be too inefficient. You're not going to be able to scale. You're not going to make enough money. And maybe that's the problem, is that women are coming. We are getting these solutions. But early on, if men are saying that'll never work, we can't even get off the ground. I have never taken out a loan for my business, and I've never taken any kind of equity. And so this was all bootstrapped 100% from just some small savings that I had. If I was, on Shark Tank, I don't think that they would have invested.
No, you wouldn't have been Shark Tank appropriate. In fact, only 1% of all companies that are started in a given year are appropriate for venture. 1%. So that means 99% of companies like yours are derisively referred to as lifestyle.
Do you know how many people were like, "Oh, it's a lifestyle business"? Because I was having my first baby. I ended up having 3 while starting it, and so they thought my business was a proxy for being a stay-at-home mom with a lifestyle business.
Well, you know what? Here, I want to really make this clear, because I think what you're doing is so important. So many financial advisors basically say, oh, how much money do you have? We won't even look at you unless you've got a $500,000 minimum. Many are even higher minimums of that, 1 million, 2 million, 5 million. Some of them are like as high as $50 million that you have to have before they'll even look at you, right? But a lot of people are at a point where they just need some help. They just need some advice. They want to do it themselves. They want to get educated themselves. They don't have enough money to make it worth a 1% fee for the amount of money that they're handing over to a financial advisor, or they want more visibility to what's happening. They don't want somebody to just make decisions based on, without their including them in that process. So what you're doing where you're actually saying, look, we're just going to give you a flat fee. We're going to charge you like a consultant or some other kind of advice professional, and we will deliver to you just what you need at a price that you can actually afford for a length of time that works for you, is like anathema in this industry. In fact, I have a friend who's a female financial advisor who's like, I can't figure out how to make that other business model work. And I hate this AUM model, but I can't figure out how to make it work. I should put her in touch with you so that she can change her business as well, because
I mentor a lot of women. In fact, that's what I was doing right before this. I have a group of women I'm mentoring, and we call it advice only. I want a lot of people to create these advice only models. I think it's the right thing in the industry, and I think the industry should move towards it. And I think it is moving towards it right now.
I hope so.
Yeah.
What's interesting is, Sarah-Catherine, you used to work in the industry. You were on the other side. You were on the dark side where Darth Vader lives, so to speak. You exited the industry to create your own product. And you went up as David to Goliath in the industry for contracts. And guess what? People saw the light and saw what the value you were offering as opposed to this behemoth financial services industry, and chose you over them where you had worked before. Is that not correct?
Yeah, I mean, so we do retirement plans, we do these kinds of large employer-based plans, and what we're doing is, instead of charging, again, a percentage of assets, we're going in and we're saying, look, we're going to price for what it costs for us to get all your people the advice that they need. And it's very, very different. So yeah, I think that there is room for different opinions here, but remember, it's making less money. And so, oftentimes we're not winning on service, we're winning on price, which is wild. And so what that means is we're a threat to the industry. We're going to bring prices down dramatically, because if you have to pay for something out of pocket versus you just give someone money and they get to just take it out without you even knowing how much they're taking out, you can take a lot more money out secretly than you can with someone having to write you a check. When someone is writing us a check, they get to evaluate, did they provide me value for this check? And that is what the financial industry is not having to do right now.
Yeah, and this is from an insider, and it's just so true. And if you want to hear more about what Sarah-Catherine has to say about the industry as an insider, she did an amazing talk at the 2025 Bogleheads Conference. I did drop that in the chat. I love it. She also did one for at the Economy Conference, but she is like, blowing that up, and her knowledge from both sides and actually, figuring it out just says a lot, in my opinion. And I hate to throw out a lot of statistics, but one other statistic is I looked at the S&P 500. So these are the 500 largest U.S. companies. I'm like asking ChatGPT how many female CEOs. We don't have a poll for that, but have the number in your head. Out of 500 companies, that's a lot of companies. Essie, do you know this one?
No, Bill? What is it?
Or Janine, Bill?
How many Fortune 500 companies are?
No, well, I did the S&P 500, which is about the same.
Yeah. So I think I have one for the Fortune 500.
What's your guess?
11%.
Okay, Bill, what's your guess?
Yeah, I'd say, maybe 5% of the 500.
Oh, ding, ding, ding. The guy in the room, the guy in the room won. So it's 20, as best Chat GPT can find, there are about 20 female CEOs in the S&P 500, which is roughly 4%.
Wow.
Oh my God.
Wow.
How ridiculous is that?
So this is an Our Sheconomy event that Invest for Better is leading. And one of the headlines from Our Sheconomy, if women had been equal partners in the economy for the last 100 years, half of all Fortune 500 companies would have been founded by women, not just run by women, founded by women. So I think that's a really important thing to be aware of too. So it's obvious from this conversation that the current financial system does not reflect women. It doesn't reflect our choices. What Sarah is doing is a perfect example of how when women step into financial power, everything changes and we do things differently. We do things differently in terms of how we run our businesses. We do things differently in terms of how we invest. We do things differently in terms of how we give. And those different choices actually have outperformance associated with them again and again and again. So I want to go back to that idea of money is power. And when we give it away, when we let somebody else deal with our money, we are walking away from our power. So we've been talking a lot about what this looks like on an individual basis. Now we have a question about what it looks like a little bit collectively. So by 2030, what percentage of US wealth are women expected to control?
I think this is fantastic, and I'm looking forward to this day.
Yeah, and the reason that it means so much to me is because collectively we can do a lot. We can do a lot. It's just sort of amazing. We can literally, in my view, change the economy with the way we choose to invest our money. And part of what Invest for Better is all about and what our Sheconomy is all about is helping women realize the power and the potential of their money. And it's also helping women realize that what we invest in also really, really matters. And all of our money is having an impact in the world. And if we choose to make those investment decisions consciously, then we can really have a very different economic outcome. Okay, so Sarah, what is the right answer here?
All right, so it looks like we've got some smart people on this. We've got a correct answer collectively. So 40% of assets are going to be controlled by women in 2030.
And that goes up to about 70+% by 2048. So this is big, you guys. This is really big. Okay, I want to just be cognizant of time. I want to make sure we get all of this because I think the next thing we want to talk about a little bit is that values piece that I brought in. And so some of you have probably heard of values-aligned investing, ESG. ESG is sort of a term that is not very popular right now with the current administration. But what's really important to understand about values-aligned investing is that the origins of this actually go back a couple hundred years in this country. It goes all the way back to the mid-1700s. The very first instance of values-aligned investing in the United States was the Quakers, who said that it was not all right for their members to make money off of the slave trade. That was the very, very first version of this. And then values-aligned investing started to gain some traction again in the 1960s and 70s around apartheid in South Africa. But some of the earliest proponents in really driving it, get this, were Catholic nuns. So Catholic nuns had assets, and they started to realize that those assets were actually working in opposition to their values, to what they were as nuns, to helping their communities. And so they started shifting their money and investing in their communities and helping the people that they were trying to help with their time and energy. So Catholic nuns, early starters in this. Other very early players in the values-aligned space Women. It was a woman who came up with the very first values aligned index. A woman, Amy Dominy. She still has a business. It's called Dominy Investments, and they help people invest this way. First firm that ever was formed to help provide financial advice and assets around this, woman. Joan Bavera, she started something called Trillium. It still exists. So women have been really important players in this space for a long time. A lot of people believe that anything that you invest in, particularly in the stock market, that is for environmental, social, or good governance, will underperform traditional investments. So we want to look at that one a little bit. So the next question is, how do ESG screened stock market funds perform against traditional investments?
We might want to define what ESG stands for real quickly.
So ESG stands for environmental, social, and governance. And it's a set of what people come up with is an actual score based on a whole bunch of different criteria where they look across the environmental spectrum, like how is this company thinking about what's happening in terms of climate change? What are they doing in terms of the things that are happening with biodiversity, particularly if they need product from the environment for their business line? What are they doing in terms of the water and quality of water if that's an issue for them? So all of these factors that are environmental that could have material impact on a company's business and profitability. Same thing with social. How do they treat their workers? How do they treat their customers? As more and more people are pressuring companies to behave a certain way or not, how does that measure up? And then governance has to do with their ethics. What kind of boards do they have? Are they doing things that are honorable and moral? Are they breaking the law? So these are all measures that you can take to look at how a company is performing beyond just the standard financial performance. Okay, so Bill, I know you did some research on this, so why didn't you take this question?
Well, I'm actually very impressed with our audience, and they're 100% correct. The importance here is it doesn't underperform. Really. I mean, you can make these choices, invest according to your values in a market-based product, and there are many other ways. There's a whole spectrum of values-aligned investing. This is just the easy button, the market solution. But you can buy the ESG S&P 500 and do the same with better values maybe in the companies you're choosing as buying the S&P 500 by itself. So the important answer to this question for me is no, I will not lose by picking investments that are better aligned with my values, at least in a market-based product. So, you know, this is back tested over, I don't know, maybe 10 or 20 years. They've only been around 1 or 2 decades. It's not, we don't have a large amount of data on this, but the initial recency bias potentially data confirms that, you know what, you're going to do just the same, I would say.
Yeah. And there are massive numbers of studies that have been done on this, and some of them were mega studies that looked at all of these studies beforehand. So you're right that there is only about 20 years of data, but that 20 years of data there's a significant amount of it to back this stuff up. So, and Jackie, I know you have a personal story about this, don't you?
Well, I forgot the story, but I don't know if it was this, but I did want to mention it. So when I was working, I retired in 2019, but we had an ESG fund that was available inside the 401k. So I know most people, and I guess this is still correct, SC, correct me if I'm wrong, but most people still start investing through their workplace. So their 401k, 403b. And so the first thing you get is this like big ugly list of funds to choose from. And so I was recently doing some work around 401ks, and I pulled my old 401k, and we had an ESG fund in there. And I said, oh, this is timely. So I looked at that compared to all the other, broad market stock U.S. index funds. And I look at longer term, 5-year, 10-year, if it's available, or maybe 3-year. And the ESG fund performed better in all of those long-term scenarios. So I was very happy to see that. So I guess the moral of the story is that you don't necessarily have to go out and do a ton of research. It could already be available to you. So I guess the takeaway would be take a look at your 401k or your employer sponsored plan and see if there's an ESG option, and take a look at how it ranks versus its counterparts that's not, ESG. And I want to also recognize that values and values-based investing is really the newer term, the appropriate term, but most companies, most funds are still calling them ESG. So if you see that, they're pretty much the same thing.
That's changing a little bit because there's been so much pushback against ESG. And just to explain that a little, because I think it's important to understand, a lot of people have said, oh, this kind of investing doesn't work. It is, you don't get the same return, et cetera, et cetera. However, the reason we have the kind of pushback we have is because it was actually having a very significant impact, particularly on the oil and gas industry. So the oil and gas industry put up $1.6 billion to underwrite an anti-ESG campaign, and that is why we have it. It's coming from the oil and gas industry because they saw that people were starting to divest from them. Why are people divesting from them? Because if you look at the last 10 or 15 years of the oil and gas returns, it's been on a downward trajectory all of that time with certain blips. There's a blip right now that's happening because of the Iran war, but without those blips, you're seeing a downward trajectory from that. So I think it's always really, really important when we see news, when we see pushback on things, to question a little bit about where it comes from and why it's coming from that place.
I think it's worth noting how incredible it is of how easy it is to invest in these now. And I think the bigger kind of takeaway that I hope many people on this are seeing is that investing is actually the easiest part of money. Literally the hardest part of money is living below your means. Like that's probably 90% of how hard money is. And then investing is part of that 10% remaining of just kind of more annoyances of money and just staying on top of it. And so the beauty is that for people who want to go after ESG or values-based investing, it is as easy as clicking a button and putting your money in it. And that is what's great, that we have these passive alternatives that, are very similar to being able to just simply buy the entire market the way we are right now able to do.
Well, my sister, for example, who's a professor at Emory, her claim to fame is she clicked the most aggressive button on her 401k when she entered her workplace. She didn't look at her 401k. She didn't know what she was invested in, but she didn't look at it for 20 years until she came up for air and said, what's there? And she didn't realize that, in spite of the fact that she was invested in all of these funds and it was complicated, she was financially independent. And the biggest feature of this whole thing was she didn't look at it or mess with it. Yes, it wasn't maybe optimized. It wasn't maybe this or that. But when she woke up and then finally heard about ESG funds, she immediately transitioned everything from the S&P 500 into the Vanguard ESG version. She's like, I didn't know I could do that. It wasn't out there for her. And so she's cleaning up her 401k, as Jackie likes to say. But, set it and forget it. But just when you set it according to your values, because, inertia will carry you forward. And then if you do forget it and don't look at it and, automate everything, like Sarah-Catherine will tell you, you will be financially independent in 15, 20 years, almost guaranteed.
I'm going to counter that a little bit, because I really advise against setting it and forgetting it. I think you really need to look at it at least annually. So let me give you a counter story to that. So I have a friend who did kind of the same thing. She had 4 different retirement accounts, and she just kind of set them, did what her firm told her to do, and didn't think about them again. Well, she's getting close to 60 now, and she's starting to think about them, and she had me look at it. Here's what I found. Every single retirement fund that she was in, she had the exact same mutual fund. All 4 of them, exact same mutual fund. And that mutual fund had been underperforming the market consistently for 20 some years. So she left a ton of money on the table by not looking. So at least look once a year. I look quarterly at my stuff, but I think it's really important to pay attention because
Well, I completely agree with you. It's not actually a counter. It is important how you said it. And, creating the foundation in which you build your house is the most important part. It takes the most important. But once you have aligned everything, yeah, you can look at it once a year. I agree. And it's not just, I don't encourage checking the most aggressive box. You got to know what's under the hood. You got to know a little bit about the engine, at least how to change the oil or change the tires. So yes, there are some things you have to do. And I completely agree with you. Do your research, set it appropriately, and then course correct or navigate annually, biannually along the way. So I don't disagree with you.
Yeah, and I want to say something too. The biggest threat to your money is actually not underperformance of your investments, it's you as a human. So if you look at the brain inclinations when it comes to money, and you can look specifically, actually Hidden Brain has a terrific podcast out this week that goes through all of our kind of limbic system and malfunctions of the brain when it comes to money. But more specifically, when it comes to investing, if you look at what Bill had said earlier, recency bias, but loss aversion, optimism bias, a lot of these biases cause us to do really, really dumb things with our money, especially with investing. And so what I think is really important is if every single woman had an investment policy statement, we call that an IPS. You can probably generate one for yourself if you want to put one in that, you want to have passive investments that you check once a year. So you could have literally, probably ChatGPT could probably help you create your own investment policy statement. But it really comes down to discipline and staying the course. Where people get messed up is that they come up with kind of a plan, but they're not committing to that plan for decades. And so that's where you have these little tactical moves like, oh, I heard someone, at this cocktail party is putting all their money in GameStop, right? Like if you have an investment policy statement and you say, you know what, no matter what I overhear other people doing, I am sticking to my plan, then you get to avoid these massive brain malfunctions that we naturally have occurring that prevent us from doing well with our money.
Great point. Really great point. Well, I think we've shown, I hope, that you can do well and do good at the same time. We've talked a lot about the stock market, but it's also true across all asset classes. It's true with your cash, where you put that, with your fixed income. If you do private investing, I'm even looking, I invest in real estate. I'm even looking at how I can do real estate in alignment with my values. So there are a lot of options out here. And I kind of think about it. I used to decorate cakes when I was a kid. And I think about this kind of investing as a cake, because what you said about the investing part and the learning that, you got to do that. That's the cake. You got to know, to Bill's point, you got to know and be smart about the choices that you're making. But the part that makes the cake awesome is the icing, truly. With a cake without the icing just is not a cake, in my view. And that's where the values piece comes in, particularly for women. It's like they're not interested in all that numbers stuff. They want to know, how is this going to help me? How is this going to help my family? And when they start to realize that their money is actually doing really cool stuff in the world, it's pretty amazing. And even in the stock market, you can buy those broad-based index funds that you're talking about, Sarah. But if you want to play with a little bit of your money, take a little bit more risk with it, maybe have a higher upside, you can invest in exchange-traded funds that do all kinds of cool stuff. If you're interested in solar, you can invest in a solar ETF. You can invest in ETFs that only support women. You can invest in ETFs that are social and racial justice. If you're vegan, there's a vegan ETF. There are affordable housing ETFs. I mean, you name your passion, there is probably an ETF for it. You know how they used to say when iPhones first came out, you got a thing you want to do, there's probably an app for it. There's probably an ETF for whatever it is that you want to do. So look at that, pay attention to that too. So we have time for one more quick question, and it goes back to the whole collective issue. So if women in the United States move $20,000 each into a values-aligned investment, how much capital do you think would shift? How much capital would shift?
That's
And
a good one.
this is important because what we're doing financially really matters from our own perspective, but we don't think about the collective power that we have. And each one of us individually, when we come together as a collective, it has incredible, incredible power. So I'm waiting for Jasmine to turn this one around and we can see what the answer is. So this is a very smart crowd. So Jackie,
Yes.
what do you think about this?
Well, let's see here. I'm looking here. I want to make sure I'm on the right question. Let's see.
It's well, they got it right. They got it right. And here's what's crazy about it.
I got it
So
right.
these numbers are kind of meaningless, right? So what is 2.56 trillion? What is that? What it is it's more than the total GDP of Canada.
Yeah, that puts it in perspective for sure.
It definitely puts it into perspective. So I think that what we tried to get across here in this session is that, women were left behind for a very long time. Some things are changing, and that's very powerful, but it's important to remember that things can go backwards. So particularly if you're young, do not overestimate or do not expect that what women worked so hard to gain will always be here. There are forces underway right now to try to take these powers away from us. So we have to fight to continue to keep them. So we are now in a very interesting space. It's getting better and better for women all the time. Young women are capturing that. We're moving into a time where there is a huge wealth transfer happening and where we can really step into our power. And when we use that power and do things differently, we can literally change the world. And that is what our Sheconomy is all about. It's about our ability to make choices that deliver those headlines, not as fantasy, but as reality, as something that really happens, as a time when our kids don't have to go through live shooter drills anymore, when men live as long as women, when cervical cancer has been eradicated, when kids are learning about this kind of I can't speak, but when they're learning about these kinds of issues in school. California just passed a law where all the kids in high school are going to learn financial literacy in the state of California. So these things are important, and these come when women have positions of power. So thank you to my guests for being here. It was so fun to have you all, and you're all so smart about this, and it was such a pleasure to speak with you and have you play this game with us. Thank you to everybody who participated. And as I said, after the session is over, we will pull some winners, and some of you will get emails from us saying that you won a prize, and you just give us your email address and your address, and you'll get those. And thank you all, and come back to our next event, which is going to be on April 23rd. Our next event is April 23rd. And we are going to be introducing some really cool investment opportunities that you have in the stock market to align your investments with your values. And for those of you, if you have questions, we'll stay on Zoom for a little while to answer any questions that people have, and we'll let you come on screen and answer those questions. So,
And
I want to take a moment. We've got
the one in the Q&A, just FYI. We'll have that one first. Go ahead, Bill.
Go ahead.
I just want to thank Janine, Jackie, and Sarah-Catherine. I am really blessed to be friends with them. I am blessed to be in this room with such fantastic women in the audience and on the panel. I just want to encourage you all to support the men in your lives that support women and bring other men into the fold. Because it is the way of the future. It may be contrarian now, but it will be the norm. It is how we redefine being male, is in supporting the women to be all they can be with their financial, social, other potentials. So, we're in this together. And it only disturbs me when I see like this enclave of just women talking and there's no men in the room. Yeah, flip the script, fine, but bring men into the room so that we can see where you're going and go there with you.
Couldn't agree more. This is so about men and women. It's not about women taking over. It's about men and women together creating a future where all of our strengths are brought to bear and we co-create something much more powerful than what's been here before. So,
well, I think since Bill is the only guy on the panel, we do have a question that we'll answer,
okay.
but I do have a big question for Bill, being the only male on the panel. And it's like, how I feel like a lot of times men are almost offended or feel left out when it's a women only thing. So how do we frame it better so that they want to be a part of it and supporting it and uplifting it versus feeling like we're in competition? Like I see that in the financial planning world. I see that in a lot of spaces. So many of them are not as open and I guess embracing as you are. So how do we do that? Get the men in our lives, in our circles, in our communities, and our worlds to see this as something that they could help, uplift and be a part of?
Well, that's a very good question. I think I saw what happened to my mother as the product of a really bitter, angry, financially devastating divorce and her own disempowerment as kind of a force to be reckoned with. Because in a talk that I'm going to give on Late Starting, she is Dorothy in The Wizard of Oz. We are all on the yellow brick road together. In my story, Jackie, you're the scarecrow looking for a brain. I'm the cowardly lion looking for courage. Becky, my previous co-host, is the Tin Man looking for a heart. And we're all going down the road together. But my mom is Dorothy, and she wore the ruby slippers because in the end, we have to realize that we have the power to do these things and we're our own worst enemies. Just like our brain is our worst enemy with the market and we're wired for failure financially, and we have to embrace neuroplasticity or changing of the brain, which is what we're in now. We're tilling the soil in gender identity. What does it mean to be a man in this world? What does it mean to be a woman in this world? Are we giving up in letting women rise to their potential, or are we gaining collectively and individually? It's really the contrarians in this world. It's sad because contrarian should be the norm. And I am happy to be in this space because I want more men not to be threatened by what women bring to the table. It is so important to listen. And this is the room I want to listen in and learn from because, in some ways, men have had centuries and decades to screw it up. Let's let women drive the car for a little while and, show us maybe the better ways, whether it be ESG or whatever, to harness, true power and use money as a tool to make the world a better place.
Fabulous. So
thanks for your perspective.
Yeah, there is one question that I saw for you, Sarah, about how participants can learn more about attending your mentor sessions.
Yeah, I would love that. So I put my email in the chat, so you can just email me directly. And we meet quarterly. It's a lot of fun, and you can be anywhere from financial planner curious to I'm ready to go take the CFP. You can be at any stage, and we'd welcome you. Yes.
Okay, we've got another question. I'm a huge proponent of passive investing, but do you ever support direct indexing as a tool for tax harvesting for higher net worth individuals?
I am a keep it simple. You don't have to do these things to do very well with growing your money. So just because you can doesn't mean you should. And so I don't do it. I keep everything very simple. I have very simple index funds. And I think there's also another question, Janine, in the actual Q&A. I don't know if you saw that.
I'm not seeing where the Q&A is.
I see it. I can read it, but I have to ditto what you're saying, SC. I retired in 2019, and I fiddled with it, my portfolio and my allocation just a little bit. But since I retired, which is 7 years ago, frankly, I don't do much with it. I mean, I look at it for good governance to make sure there's no malfeasance going on. My account's still good. How is it growing? But I stick with low cost index funds. The only thing I do a little bit out of the box, only because I have the interest and the inclination, is I do have a small single stock portfolio, which is where I can look a little bit closer and kick out any companies where I don't like what they're doing. Like I had owned a company, I didn't realize they were heavily investing in private prisons, which I don't support. So I was able to easily get rid of them because they were an individual company. But I don't do much anymore. It's mainly my single stock portfolio is mainly larger companies that I don't have to watch very much anymore. So if you have the inclination, there's a ton of like research resources, between YouTube and podcasts that will support that. But at the end of the day, Warren Buffett made that big bet, a while ago, that putting index funds up against hedge funds and actively managed funds and asset allocation, things like that. And by a long shot, the S&P 500 passive index fund won out. So if you have the inclination, that's one thing. You want to have fun with it. But if you think that it's going to get you better overall performance, maybe not. But I don't think that should be the reason, because you may be disappointed based on the research and the studies that have been done.
Yeah, and it's just another human.
I'll say something different here, because I do direct indexing. So I've done it in my portfolio. And part of the reason that I do it, I've used a company called Ethic. And the direct index, what it allowed me to do is they gave me a questionnaire that I filled out, and I prioritized my values to a very significant degree. And then they used that to build an index specifically for me that they benchmarked against what I asked them to benchmark it against. And so they were able to build me a specific index that achieves my goals. It's not something that everybody can get into. I think you have to get in through a financial advisor. I think the minimum is $250,000. But I made the decision to do that, and it's doing well. I mean, it's doing well for me financially, and I know that it's also achieving a lot of my goals. I could make it even better in terms of my values, but then I would be way off the benchmark, and it probably wouldn't be performing as well. And so I've had to make decisions about what is my personal trade-off related to how much I want to push for value. And this goes beyond the ESG conversation. This is like, how much do I want to push for value, and how much am I willing to give up in financial return for that? Because in some places of my portfolio, I'm willing to take concessionary returns. Not everywhere. And nobody else has to do that, but I'm willing to do some of that. But even with this direct index fund that I've got, I'm not really giving up financial return. If I wanted more value, I would.
This is an interesting discussion, because direct indexing, there's a trade-off, right? Are you really going at it for more performance or for values-aligned investing? And you're trading off your time because there's more work involved, but you're outsourcing that to an advisor, which gives you back your time, but you're paying for that resource. So there is more cost to doing this, potentially both in time and money. And certainly it is a way to hone in on your values and what you want to invest in. To Sarah-Catherine's point, yes, keeping it simple, you will probably have as good, if not better, returns with meddling in it. That's called the behavior gap, right? The investment return is this, the investor return is lower than that because the brain gets in the way. As far as what I do, it's fundamentally simple. I have about, in my retirement portfolio, which is different from accumulation. I think you got to distinguish between these two domains, at least in my world. I have about 6 or 8 funds, and it's based on a risk parity approach, an all seasons approach. In accumulation, 2, 3 funds, keep it simple, grow it to the moon, set it and forget it. According to your values, make it as complicated as you want, but realize you're giving up something, whether it be in performance, in time, bandwidth. And I hired a financial advisor. I went from AUM, a victim of the dinosaur industry of AUM, exited into DIY for 10 years, and I re-entered the advisor space where I was the customer and they were the product. It wasn't the other way around, where I am the product that they want. So I did it very intentionally because I wanted to focus on life and not money as much anymore. So I've run the gamut of the advising space and the complexity of the simple space. I found my Goldilocks life between investment complexity and managing my time. So it's a balance, just like everything. And you create your life like you create a portfolio. You want diversification of personal assets, financial assets. You want macro assets in the stocks, bonds, whatever. And then you want to make it simple. But lastly, there's this great principle that I use called the Bruce Lee principle. Take what is useful about what we've talked today. Okay. Discard what is useless that didn't, resonate with you, and then add something that's uniquely your own. That's the Bruce Lee principle. And that's why all of us do something a little bit different, because our own unique personalities will be represented in how we invest and manage and spend and vote with our money.
Yeah.
Well, Bill, I love the Bruce Lee principle, but in this group, we like women analogies.
Okay, we got a couple more questions that I want to put out on the table. So there's a question: how do you help women who don't like high fees, help them invest in values-aligned funds? They tend to have higher fees even if they perform well. So here's two answers to that question. First of all, there are some very low fee index funds that are ESG that are doing well. So there are opportunities like that. I gave a talk at Sheconomy, which came up in this conversation earlier. And one of the funds that is considered the holy grail of the FIRE movement, it's like, if you want to just invest it and hold it for the rest of your life, they believe the fund to invest in is the Vanguard Total Stock Market Index Fund, VTSAX, the Vanguard Total Stock Market Index Fund. That is the holy grail of the FIRE movement. And they love it because it's got very low fees. If you look it up on one of my favorite tools is called As You Sow, Invest Your Values. If you look at VTSAX up there, it does terribly on every category in terms of the environment, in terms of gender equity, in terms of prisons, in terms of deforestation, in terms of you name it, it does terribly. They have another fund, it's called ESGV, which is very similar to VTSAX. It holds a lot of the market. It is also incredibly low fee. I own them both. And my ESGV does a lot better on As You Sow. It does a lot better for the world. Not perfect, but a lot better. And it has traditionally outperformed VTSAX. It's down a little bit this year because of the oil and gas situation that's going on, but it has traditionally outperformed. So there are low fee options, and ESGV is just one. The other thing, and others on this call may have a different opinion here, but I don't care about fees. I care about return. So if I'm going to have the choice between investing in a fund that gives me a really low fee, but the net return at the end of the day is 2 points lower or a half a point lower than another fund that has a much higher fee, but is giving me a consistently higher net return, I'm going to go with the high fee net return every day. So I don't know if others, and I know in the FIRE world, low fees is like a beating drum. It's like the coxswain in a crew. But I care about net return. That's what I look at. Do others agree with that or have a different point of view?
Yeah, I think I agree with. Oh, go ahead, Jackie.
Oh, no. Well, I was about to say, I went back to that list of funds from my old 401k. So they don't always have to cost more. And to your point, I think net return is important. So there was 4 large cap, U.S. index funds in my 401k, which is typical what you might see. And I looked at the fees. Okay. So there was one that was 0.0%, which was the lowest. And the second lowest was the ESG fund. However, looking at the 10-year, the ESG fund did perform 1% better when the expense ratio was like 0.12 versus 0.02. So the total return net of fees was better. So I don't know that I feel like that messaging is out there that they're always more expensive. Not necessarily. And I just use that as a real life example on what I had access to through, my 401k. So Etsy, I'll let you go. I'm sorry.
Yeah, and I want to be really clear when we're talking about fees. To me, there's like 3 different categories of fees. And so we want to be clear what we're discussing when we're talking about fees. So there's the fees for the investments themselves. And Janine, you were talking a little bit about that. There's the fees for someone investing for you. And then there's the fees for someone doing financial planning for you. So if I look at the fees for investing, for the investments themselves, whether it's a mutual fund or an ETF, typically you will find that lower cost funds have a higher outperformance. So the S&P 500 has a research arm called the SPIVA Index, and every 6 months they do a backward analysis of the relative performance of actively managed mutual funds to just the average benchmark. And over a 15-year period, especially when you look at the larger companies like compared to the S&P 500, 89% underperform. And the reason for this is that a lot of these funds can't get over the hurdle of their own fees. So while it is possible for higher fee funds to have better performance, there is a lot of efficiency in the market that makes it very difficult to outperform. And so when Bill said I was in the industry, he's right. I used to be a stock analyst. So I was a stock picker. That was a lived experience of how difficult it is to outperform the market, even when you're doing it, all day long and have to be right on just 18 stocks. But then when we look at, so the next category of fees, which is how much should you pay for someone to invest your money? And this is very controversial because a lot of people think like you shouldn't be paying AUM fees. Anyone can go out and do this on their own. Well, I jotted down, Bill, what you said, that gap between actual performance, so the performance of a fund versus the actual performance of investors, and it's never the same. And that's that behavior gap. And so if you know that you cannot be disciplined, that you're not going to do your annual financial rebalance, your annual investment rebalance, that you're not going to stay the course, that you might sell when the market is down, it is worth every penny of a 1% AUM fee. And 1% AUM is pretty much the industry standard still. It has not broken, should break, but it has not broken yet, but it's worth every penny. Now, I am of the belief that a lot of people can do this on their own and should do it on their own. And so that's where maybe you're buying and paying fees for the financial planning, where someone basically says, here's how much you ought to save, here's where you should invest for tax efficiency, for values, for how, however you're trying to invest, and then helps you stay the course. Typically, you save a lot of money doing it that way, especially if you're doing the investments yourself. So I hope that kind of clears things up on how you can kind of consider what fees are worth it to you and why you would pay them.
Really,
yeah, it's always caveat emptor, buyer beware. And I was not an informed or educated buyer when I entered the sales market of the AUM industry. And in order to catch up, I had to take back my money and DIY it and forego those fees. And I think DIYing is imminently possible to do by yourself with occasional advice only, hourly, flat fee advice along the way as you reach decision points like buying a house or saving for college or tax advice. You can get episodic help. You don't need to have it, and most people don't. But for my purposes, I went back into it because of that behavioral component. It was, I did succumb to tracking error or jumping in and jumping out. I did a little too much male things in the market, and I needed somebody to be, that little voice on my shoulder saying, "Don't do that. You've done that before." And I also didn't want to worry about it. So there are reasons to DIY, there are reasons to have an advisor, but you've got to, on both sides, you've got to do your homework and understand what you're doing. You've got to speak the language, you've got to act the language, and getting that literacy into the schools is one thing, but we got to get the skills into people's hands as well.
Right. So I did the same thing as you. I DIY'd in the beginning, then I built enough money. I was like, and I was so busy. I was like, I don't have time for this. So then I went to the advisors. And then when I decided to start investing with values and they weren't delivering for me, I took it back. I started DIYing again. And then I kind of got it all figured out. And I was like, okay, I don't want to deal with this anymore. So I'm back to an advisor. But one of the things I talk about in my book is about financial advisors, and I've fired like 4 of them over a 10-year period, right? And the thing that I've learned is what's really important in an advisor, what I learned when I went out and I was interviewing them, they'll all tell you exactly the same thing. They'll tell you, this is how we're going to take care of you. This is how frequently we're going to meet with you. We can't promise you any kind of returns, but we're going to shoot for this. I mean, it's the same thing, every single one, it felt like. And what it really comes down to at the end of the day is how it feels to you. Does this feel like a person that you can trust? Does this feel like a person that you can build a relationship with? And particularly for women, is this someone who'll teach you? Because your financial advisor should be your financial educator as well, and could be your financial educator. And there's a lot of talk I see in different online publications for financial advisors about how everybody needs to start being more female focused in their financial advisory role, and that women want something very, very different from their financial advisors. And what they want is a connection. They want to be heard. They want to be educated. And so look for those things. If you're looking for a financial advisor, look for those things from your financial advisor. And I would highly recommend you go look for a female advisor for a couple of reasons. One, they're going to be more likely to be that person for you. And second, I just want to uplift women in every way that I can. And so one way to uplift people in the financial advisory space is hire a female financial advisor.
And I was about to say that small number of CFP professionals that are women, it's not because they're not just as good. There's a lot of other reasons, but they're probably better, as you're saying. So Janine, for the 3 that you fired, the 3 financial planners, four. Yeah. So were they men or women or
both?
Both.
So the first one was really disappointing. The first one was early when I decided that I was going to start investing all of my money in alignment with my values. And this man did that. He had a track record doing that. He'd had a track record doing that for people who had way more money than me. And I was like, what if I bring my little piddly pot of money to you? Will you help me? And we can prove that even somebody with not a lot of money can do this. And he was like, done, we're going to do this. So I sold everything. I turned everything into cash so that he could reinvest it. And then he got busy with other things. And my cash sat in cash for 9 months while the stock market went up.
Which is why you stress the whole don't set it and forget it.
I was so mad. I mean, I had taken capital gains losses to sell it. I sold it. He did nothing with it. I lost money on the upside as well. And so after 9 months, I was like, I'm done with this dude. And I found the next one. And the next company did well for me, but they weren't getting me into enough values aligned stuff. And so then I shifted it again to a third financial advisor who started out doing well. But that financial advisor, I realized they were kind of although they would never call themselves this, they were more of a broker in terms of private deals, because I was interested in getting in private investing. They were constantly trying to sell me the next private equity deal, the next private debt deal. I'm like, I don't want this. No. And I realized that I couldn't make them stop. I mean, I told them, I don't want it. Don't bring it to me. They kept bringing it to me. I'm like, I'm done with them.
Can I insert here? And this is my problem with that. I don't think you should be able to call yourself an advisor if you can also be part of a sale. I think it's fine to be a person who sells things, but you can't be both advisor, objective advisor, and salesperson at the same time. And right now, that is perfectly legal in this industry. And I'm telling you, in 10 years, my goal is that that is no longer legal. You either do one or the other.
I agree. And, they called it different because it was private deals and not public deals, but it's not different.
But you're still, the point is that if you're making money, like a commission or a percentage like that, then you have an incentive to tell you to buy into that. And that's the problem. If you're an objective advisor, you should not be able to profit off the decision of the person you're advising.
I have an interesting perspective on this, and it relates to the similarities and differences between healthcare and wealth care. In some ways, a financial advisor is like your primary care physician who has your best interest at heart, is your therapist, is your guide, is your educator. And by the way, did you know that the word doctor comes from the Latin for dicte, which means teacher? It doesn't mean healer. And when you talk about an advisor being an educator or a teacher, he's not being a healer. He's supposed to teach you, to empower you, just like we're trying to do with women. But, the healthcare industry has the Hippocratic Oath. The financial services industry does not. And if I were a salesman type advisor, I would be the physician that's prescribing a medication to which I'm the owner of the pharmacy where you will fill it. So I'm double dipping on doing things. And that was taken out of the equation a long time ago for physicians. And they're
or profiting on the very pharmaceutical that you're prescribing.
Right. And that was replete in the healthcare industry, and that was taken out. The drug reps are no longer buying you lunch as a resident in the hospital. So there's a lot of similarities. Medicine may, for better or worse, be a little bit ahead of the financial services industry. And, it's an older institution and it's come a long way. And the financial services industry is following the same path. It will get there. There will be a Hippocratic Oath, and we will have more of Sarah-Catherine and Jackie in the world than we will the AUM people. It will flip. This equation will flip, and when it does, it will flip rapidly, because I would compare Sarah-Catherine to, say, the Jack Bogle of the world. Yeah. She is a disruptor.
Jackie Bogle, yeah.
Jackie Bogle.
And I didn't know you were the largest flat fee only
advice
only firm in the country. Bravo. Congratulations. I have not heard that one.
Well, we got to start saying that when we mention her on the podcast, that she has the largest advice-only firm.
So you guys...
I mean, to be clear, it's a very small industry. So.
Correct. And we know that, but boy, we're going in the right direction. And just real quick, Dominique put something in the chat I thought was really important. She says, I stayed with Principal, a female rep, versus Fidelity, a male rep, because the male felt condescending and female was actually teaching me.
Yeah.
Huge difference.
Huge difference.
Thank you, Dominique.
So I know we're out of time. I'm realizing there's one last question that we didn't address. So let me do that super quickly, and then I'm going to bring us to a close. So the question was, how do you know if you're willing to take concessionary returns and where to do it? Do you do it bonds, equities? So let me answer that first. So personally, I take concessionary returns in areas where I think there's a really outside value that I really want to pursue, and I'm willing to take a concessionary return, but I'm not willing to do it a lot. One place that I have done it recently is in a real estate deal that I went into that is an affordable housing deal. And I knew going in that it was concessionary, but I also knew that I was helping 2 young women developers build their business, and that there was a good possibility that I was going to get a nice enough return. So I went for it. So it's very, very personal, this question, where you choose to take concessionary returns. You can take them anywhere, but do it judiciously with the amount of money that you have and something that feels good for you. The second question they asked is, if your advisor is using platforms like Ethic or Your Stake, do you still make some changes or decisions, or just trust those algorithms and data on face value? So in my case with Ethic, I trust Ethic. I know that they have built an algorithm specifically for me. I know the company, I know the people behind it, and I trust that they're doing the right thing with it. So they do adjustments on their side from time to time, and my financial advisor is in between me and them. as well. And so I know she has regular conversations with them, and she would alert me if anything is amiss. And notice I'm saying she, and I absolutely adore my current financial advisor. She's the best. So with that, again, thank you all so much for doing this with me. It was really something we've never done before. It was super fun for me to work with you all to make this happen. And we've got 17 people who have stayed on for a full hour and a half with us. So
I want to know if the Janine ETF is publicly available for trading.
Yeah. When are you going to have one?
Your direct indexing ETF, that probably has some legs on it.
I'll think about that, you guys. I know some women who have run ETFs. It's a job.
Look, maybe we need a ticker that is SHE. Right?
That's a great
for those of you still in the
idea.
audience that have joined us, I just want to thank you. I'm really honored to be a part of it. And if you're a late starter out there, bring somebody into the fold. Listen to our podcast. Sarah-Catherine's on it. Janine's on it. And Jackie, what do we always say at the end of the show?
Let's see if I can get this right. It's never too late to start.
It's better late than never.
Yeah.
And it's always
The right time to catch up to FI.
To catch up to FI.
We're still perfecting that.
Guys, perfect. Thank you all so much.
This has been great. Thank you,
Thank
Janine.
everybody.
Let's see.
All right, bye.
y'all.
Bye.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. And our editor is Fritz Brizard. We love them and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofi.com and check out our vetted resources, partners, and affiliates for discounts and their services because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to FI. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to FI. Cheers.